Hello, everyone, and welcome to the Inside ETFs weekly webinar. My name is Matt Hogan, and I'm the CEO of Inside ETFs and your host for today's webinar. In today's show, a big question: how do Bitcoin, Ether, and other cryptocurrencies fit into client portfolios? Now is the perfect time to be talking about this. Bitcoin prices recently crossed the $10,000 mark. Although they've crashed here and there, they seem to be heading nowhere but up. Bitcoin's not alone either. Ether is up 5,000% year to date, and some say it's a more valuable and sophisticated approach to the crypto market than Bitcoin itself. But all the coverage of crypto and Bitcoin reads a little bit short-term, hyperbolic, and sometimes confusing to me. People either say it's going to 1 million or it's the greatest scam of all time. So my question is, what does it all mean for financial advisors, and what should they be telling clients when they ask them about Bitcoin? Today we're going to professionalize the Bitcoin discussion, and we're fortunate to be joined by some of the world's leading minds on the intersection of Bitcoin and financial advice to help us do just that. Gabor Gurbax is the Director of Digital Asset Strategy for VanEck, which recently launched a series of cryptocurrencies indexes and has filed for a Bitcoin ETF. Jan van Eck is the CEO of VanEck, and also a cryptocurrency fan and expert, and one of the persons pushing his company forward into the crypto space. Raj Lalla is the president and CEO of Evolve ETFs, a Canadian ETF provider that's looking to launch a Bitcoin ETF in Canada. We're going to ask them a series of questions, including what is Bitcoin and is it in a bubble? What's the difference between Bitcoin, Ether, and other digital technologies? How do we value these cryptocurrencies? How are they taxed, and how would they fit in an advisor portfolio? Finally, we're going to ask what's the best approach to gaining access to them and how that's going to evolve over the coming 6 months. But before we get to Bitcoin, we're hugely excited to bring in Mo Hagbin. He is the head of product for Beta Solutions for Oppenheimer Funds. Mo is here to play a game we call 5 Questions in 5 Minutes, where we dig into one critical question facing the ETF market. Today we're going to talk about the latest evolution in factor investing. We're going to grill Mo with 5 sort of hard-hitting questions, and then we'll come back to the Bitcoin panel once we get through that. But Mo, welcome to our webinar. Thanks for joining us today.
Thanks, Matt. Happy to be here.
All right. So this is on a hard timer, so if you have a timer by your phone, I'd encourage you to press go now. We're going to try to cover the latest in the factor market, one question at a time. So my first question, I was reading on your website on smart beta research, and you had a nice way of dividing smart beta ETFs into 3 groups: alternatively weighted ETFs, single factor ETFs, and multi-factor ETFs. Briefly, how do each of those work, and what are the pros and cons of each approach for investors?
Sure. That's right. So 3 big buckets. I think it's a simple way of looking at the space. First, alternatively weighted. These strategies really use either a company financial metric or another metric other than market cap to weight an index. Examples include revenue, earnings, or even equally weighted funds. The next big category is single factor strategies. These strategies generally tilt portfolios towards academically supported and commonly accepted style factors, so value, momentum, quality, or low volatility strategies. Lastly, multi-factor strategies combine 2 or more of those single factors into one portfolio. So common examples could include size and value or value and momentum strategies. Each have unique methodologies and have pros and cons, but all have a place in the portfolio, and we truly believe that investors should be giving each a hard look.
All right, we'll talk about those in a bit, but I want to talk a bit about rewarded and non-rewarded factors. You said each had a place in the portfolio, but what are rewarded factors? How do you determine which get rewarded and which don't?
Yeah, that's a great question. So rewarded factors are factors that have delivered better absolute or risk-adjusted return over time. So similar to traditional asset classes, investors should be rewarded for taking on various risks in their portfolios. So a nice framework we use when evaluating these things is we look for persistence. So does this particular factor or investment style produce good investment results over long periods of time? Is it pervasive? So does it work in regions or countries or even across asset classes like fixed income, commodities, or currencies? Is the approach intuitive? right? So does it have an economic or behavioral rationale supporting it? And lastly, is it investable? So once we kind of take it out of the academic literature, does it continue to produce good results after transaction costs and other frictions?
So what's an example of a non-rewarded factor?
Yeah, that's a good question. So, for example, if you took the value versus growth, right? So it's been well documented. There's decades and decades of history showing that value over long, long periods of time has produced better returns than the overall market, while growth is not.
Great, awesome. We have about 2 minutes left, so I'll move quickly. Since 2001, in the study you covered, the size factor has trounced just about everything. Why shouldn't an investor just buy that?
I think this all comes down to diversification and client objectives. So like diversification is important in a traditional bond or equity portfolio, it's also important when you apply it to factor investing. STI strategies overweight smaller companies at the expense of larger ones. So the intuition there is over long periods, investors are rewarded, taking on that additional risk that comes with less established names. While size has outperformed over this period, it also came with higher risk. So that's not appropriate for all investors. So size factors tend to be more pro-cyclical, so it tends to outperform when the economy is growing and expanding, but it underperforms in downturns. So it's important for investors to consider their overall objectives and allocate to factors in a more balanced way.
All right, let's talk about the approach you're taking, which is a dynamic multi-factor approach, where you combine multiple factors and you do so, as the name suggests, on a dynamic basis. Don't you risk making timing mistakes when you start rotating amongst different factors?
Yeah, there's always a little bit of a misconception between timing or tilting. So our new dynamic multi-factor products use macroeconomic signals and overall market conditions to rotate the portfolio through certain factors, but the strategy never overly concentrates into one factor. So it instead uses our macro and market sentiment views to emphasize certain factors during certain periods of time where we've historically seen outperformance. It's important to note the portfolio never actually explicitly takes a negative view on a factor. Rather, it increases its exposure to adapt and capitalize on the market environment.
All right, and the last question, there are really two approaches out there right now to building dynamic multi-factor ETFs, the top-down and bottom-up approach. Can you explain what those are?
Sure. So top-down is just think about it as capital allocation. So if I had $100 and I was interested in a momentum strategy and a value strategy, I would allocate $50 to each. In contrast, a bottoms-up approach will look at integrating factors at the security level. So in that same example, every security in a universe like the S&P 500 or Russell 1000 would be evaluated both on its value and momentum characteristics. The optimal blend of those two is what's going to inform the weight in the portfolio. So the advantage of a bottom-up approach is generally you get deeper factor exposures and a less canceling out effect amongst those factors. On the other hand, the advantage of top-down is it's quite simple and it's easier to attribute returns and where those returns are coming from in the portfolio.
All right, well, that was awesome. That was a lot to cover in just 5 minutes, and we went over by only about 20 seconds. So, Mo, wanted to say thanks for joining us. For those of you who are interested, and I don't say this on most of my webinars, but there is a really great white paper and research on this idea on Oppenheimer's ETF website. The easiest way to tell you to get there is just Google Oppenheimer ETFs, and the first real link will take you to their Smart Beta Hub, where the research is really just exceptional. So thanks so much, Mo. Appreciate having you on. I do want to bring in the Bitcoin panel. Bitcoin has pierced the $10,000 level. When I was flying to New York this week, both people on the plane to my left and my right were reading about Bitcoin. I guess my first question to Gabor is, maybe you can give us a brief, 1-minute overview. What is Bitcoin, and is it in a bubble?
Okay, so Bitcoin and digital assets, in its simplest form, it's just a shared database technology or distributed ledgers. And Bitcoin and digital assets represent a variety of use cases. Some are meant to be a store of value, like currencies, and hence they are called cryptocurrencies. Bitcoin is an example of cryptocurrency. But Bitcoin has become a form of digital gold and a store of value. So beyond Bitcoin, there are other digital assets that are not meant to be currencies, but are more like shared applications or tech platforms and have specific functionalities. They can track ownership, like land or music rights, or allocate resources, like computer storage or Wi-Fi bandwidth, or act as a platform for smart contracts. Some tokens are like mileage points or Starbucks rewards that live in your phones in their own ecosystems. So basically, these are technology investments. One has to determine if this is the next step of structuring data on the internet. The appeal is permissionless, and I would emphasize that word. Anyone can join. It's lower cost. It's not controlled by a company. To an investor, digital assets can proliferate like smartphone apps, resulting in fast growth. So that's sort of what's Bitcoin. It's sort of like a shared database technology that is, you can think about it as some form of digital gold. As far as is it a bubble? No doubt, sure, it's a bubble. It's hugely speculative, and it will end one day. But so if you do you refer to Alibaba, Amazon, or Google in their initial stock price? These are companies that are started in garages. Apple stock was probably valued at 1 cent per share when it started, too, but it is unlikely. So I would say, sure, it is a bubble, but again, it might not be the right framework to look at Bitcoin from a valuation perspective.
Well, that's an interesting question, because this, we want to focus on what this all means for the financial advisor, and for sure, blockchain technology and Bitcoin with a lower B and Ether, which I want to get into, are all super interesting. But Jan, you must get the question all the time. How does Bitcoin have any value, and is it in a bubble? So, what do you tell people when they ask you that?
Well, I think it's a little bit like gold, like Gabor was saying, a store of value, versus an asset that will generate a revenue stream like a bond or a stock with dividends. And you find the investors that don't like gold, like Warren Buffett, really don't like Bitcoin. So you kind of have to decide there's two types of investors in the world. I compare it to gold because some people like gold because it's independent of governments and it's just a separate store of value. And that's sort of how I think Bitcoin has evolved, but that's not for all investors.
That makes sense. How would you, I'm not going to ask if it is a bubble, Jan, but how would you know? It seemed like Gabor, said it's difficult to price it. How do you know? Is it possible to know? Like, is there a valuation mechanism for Bitcoin that makes any sense?
So, if you want to think about it, just kind of pure stats framework, then the total market capitalization of gold is about $8 trillion. And if Bitcoin is indeed digital gold, then if we do the math, so right now, looking at market capitalization, Bitcoin is 200 billion, gold is 8 trillion. That looks like a potential 40x increase if indeed Bitcoin was comparable to gold. Another framework that people tend to use, and economists primarily, is M1, which is the total quantity of currency in circulation. If you look at the list of countries and their M1s, Bitcoin is the 25th largest country. So it's actually Bitcoin in M1 terms is bigger than Mexico, Venezuela, and Denmark, and it's very close to Poland and Russia. But on the top of the list, it still doesn't approach the M1 that of U.S., China, or Japan. So if you look at sort of like Bitcoin as a currency, then it has still a lot of room to grow. If you look at Bitcoin as a store of value or digital gold compared to gold, then it still has a lot of potential to grow.
Right.
I mean, Matt,
Raj, I want to bring you. Yep. Go ahead, Jan. Yep.
Just one quick comment. I mean, I like to value the opinions of people who have been correct in the past. And there's two investors, Mike Novogratz, who's very active in the crypto space, and Murray Stahl at Horizon Investments, that have been early boosters, and they've been actually pretty good at predicting what's happening to Bitcoin prices. And they are in this still bullish camp of multiple times of increase. So you just can't discount what they are saying because they've been correct in the past. I think people that don't have a good track record, I think you should discount them. So there's an upside scenario that people need to think about, as well as the obvious losing everything downside scenario.
That's super useful. Raj, I want to bring you in before we move on to a few more technical aspects. I mean, you're looking to bring a Bitcoin ETF to market in Canada. How do you think about this question of is it a bubble? Is it an investable asset? Or are you thinking about that product as a trading tool and an access tool?
Yes, definitely. I mean, the bubble question's tough because this is a very new asset class in many ways that people are trying to get their head around. And I don't think I've ever seen anything in the last 5 years that's had such a polarized view as cryptocurrency or specifically Bitcoin does. And I think, one of the interesting elements, you see people, calling for Bitcoin at 40,000 by the end of 2018, and then you see people calling for 400 by the end of 2018. And I think one of the key differences with Bitcoin versus a lot of the other commodities, if you want to compare it to those, is the fixed supply in nature. Oil and some of the other renewable resources can be increased in supply through mining, whereas one of the challenges I think with Bitcoin is that we tend to have a fix of 21 million over a period. And then you're starting to see more Asian adoption as well of Bitcoin. So I think it's a really interesting area of the market right now. We're getting a ton of questions from advisors here in Canada. Right now, the market cap of Bitcoin is larger than any Canadian company in the market right now. So there's definitely a lot of attention moving into it. Part of, although I can't comment too much, as you mentioned at the beginning, Matt, that we're sitting with the regulators right now in terms of our prospectus. What I would say is that a lot of individuals that look at Bitcoin and feel that there's some good growth potential there may find it a little bit difficult or an arduous process to go through to actually go and buy physical Bitcoin. So we felt that these futures that are eventually going to list on CME and CBOE is an interesting way for individuals to participate in the price appreciation of Bitcoin inside of their brokerage account.
Yeah, and we're definitely going to get to those products for sure. When you were saying the thing about the fixed number of Bitcoin, I was thinking you can't frack Bitcoin. But to the extent that you can, we have seen multiple other digital currencies launch. The first of which comes to mind is Ether. And so I go back to you, Gabor, and maybe for our audience, can you explain, what is Ether and how it works and how it's different than Bitcoin and why it's important?
Yeah, so Ether is, you can think about it as a decentralized smart contract platform. So it is what I like to call it the trustless trust machine. Suppose we know each other for 3 years, and then you send me down to Starbucks to buy coffee, and while I leave the floor, you give me $2, and then when I reach Starbucks, I get an additional $1, and when I bring the coffee back to you, I get the rest of the $2. If a coffee cup is sort of $5. So a smart contract can do all that monitoring. A smart contract can monitor oil trading, it can monitor land rights, it can monitor music rights, it can monitor anything that can be contracted. One of the key differences between Ether and Ether is the token or the currency of the Ethereum network. So the key difference between Bitcoin and Ether is Bitcoin has a capped supply of 21 million, which is constantly mined, of course, and Ether does not have a capped supply. It has a sort of like a continuous issuance or inflation rate around 1%. So that makes it interesting for investors who are sort of looking beyond the store of value argument. And again, the Ethereum network is super useful. It was built not just as a currency. It's really a tech investment. It's not a store of value. It is a tech investment that other applications can operate in. It is the trustless trust machine, or the sort of like your global supercomputer.
Right. Jan, my question on Ether for you, and then I want to ask a little bit about the indexes, is I understand its value in terms of tracking and execution of smart contracts, but isn't that difficult to do with a price that's as volatile as it is? Like, wouldn't it be more useful at a fixed price? Like, how do you square those circles, or am I missing something about the nature of having a smart contract sort of powered by Ether?
Well, I guess I would say the price of Ether and using Ether are two very different things. So you and I could track attendees at Inside ETFs using Ether, and handle the booth and all that kind of stuff, and do any kinds of business using those protocols. It's just a public shared database that everyone can see in one form or another. The price of Ether is sort of a second factor related to the value of the ecosystem, and so I kind of put that to the other side. I guess using Gabor's sort of dichotomy of there's cryptocurrencies and all these applications, and Ether being an example of an application and a platform, and Bitcoin being an example of a cryptocurrency. I'm very skeptical. It's very, very early days for all these applications because there's almost nothing being used, in operation today. So I think it's way very speculative investment, whereas the cryptocurrencies, are seemingly accepted by millions of people.
Right. One more question on that concept, and then I want to go back to the products and the futures. You just recently launched multi-crypto indexes with 5, 10, and 25. I think that's right, different cryptocurrencies. So I guess, Jan, what's the value of diversifying your exposure to cryptocurrencies versus just getting Bitcoin? That would be one question.
So if distributed ledger technology, the shared database technology, is something that becomes widely adopted, let's call it like, browsers on the internet, I like to call Ether sort of Netscape 1.0, meaning just understand the risk, right? Netscape was the first usable browser, but neither the browser is around nor is the company that founded it. So the reason for tracking a basket of these applications is the same reason that one would buy an ETF or basket of stocks and bonds, which is you want to reduce your risk or exposure to any particular technology because it's early days and you don't know what the winner is going to be. So that's basically the idea of having an index. Okay.
All right. That makes sense. Let's talk about futures. Raj, you said your ETF is structured around futures. The futures are supposed to come to market, this year maybe. NASDAQ announced it's launching some additional futures next year. What will a product look like that holds Bitcoin futures? Will it have the same issues of contango and backwardation that you see in oil and volatility, or will it track purely to the spot price of Bitcoin? What do we expect there?
Yeah, it's a great question, and I think it's probably more so TBD. A lot of people are anxiously waiting to see how these trade on the CME or SIBO, and as you say, contango and backwardation are things that not just the banks but investors and also the regulators want to take a look at in terms of the depth of the market and the tracking capability. I mean, obviously we have a lot of ETFs that track futures of oil and other commodities, but this is a brand new area, so it's tough to make any comments as to how they're going to trade relative to the actual spot price of Bitcoin. I mean, CME has released some of the specifications on the contract, and so has SIBO, and as you mentioned, they're planning to. I know CME is planning at some point in December to list the futures, but it's going to be really interesting experience because you've also even one of the other interesting areas of this is time. I mean, there's I think only 1 hour in an entire 24-hour weekday where all markets are closed, but obviously Bitcoin is trading all the time, so it's not something that you can pigeonhole into kind of a 9:30 a.m. to 4 p.m. type of time zone. So there's a lot of interesting elements that are going to go into this. So I think a lot of us are pretty keen to see how it's going to shape up.
Yep. What about on the VanEck side? I know you guys have filed for a Bitcoin ETF as well. Is that a physical approach, if that's the right term for a cryptocurrency, or is it futures-based?
Well, we can't really talk about it in detail, but we did file a prospectus for a futures-based ETF over the summer, and we've withdrawn that application due to regulatory guidance. So that's where we are right now.
That's where that stands right now. How do you expect? Do you have any insight or belief on how Bitcoin futures will trade in terms of contango and backwardation? I just imagine with the volatility of Bitcoin prices that a future dated even a few weeks out could be significantly different from the price today. Do we expect to see that?
So there is a whole Bitcoin market structure out there that would take way too long to describe on this call, but there are 50 different exchanges around the world that many of us have never heard of that trade all these coins. But we can gather some information from that activity. There's billions of dollars of these coins traded a day. And so I'll turn it over to Gabor to tell you what that market is telling us about what, the CME contract might do.
Great.
Yeah, sure. So I've looked at a number of these exchanges, and I know some of their founders well. And so basically, if you look at the curve in the short term, so less than 1 month, the Bitcoin USD futures prices tend to be below the respective spot prices. When I see the highest depreciation reached around 9 days, so it's kind of going down towards converging towards a spot on the short term. On the midterm, between 1 and 3 months, contracts start to appreciate, but premiums are still negative, and in the long term, premiums are positive. So what this futures curve tells me is that there's a slight negative view on Bitcoin USD spot rates in the next few months, but long-term investors seem to be very optimistic about sort of like the distant, if I may say 3 months or more is a distant future of the Bitcoin, but investors are optimistic on the Bitcoin. And I'm happy to be in touch a little bit more about this later. We don't have too much time on this.
Yeah, no, super interesting. Someone needs a dynamic roll Bitcoin futures ETF. A few more quick questions. I'll throw these two out as a jump ball. First, how will Bitcoin futures ETF be taxed? Does anyone know?
Well, it's really dependent on the structure and on the product. So it's hard to make a blanket statement on that. For those investors or who will listen to this call, I encourage everyone to report Bitcoin taxes, and they are taxed as capital gains. So you may read more guidance on this on the IRS website. I think they have been very thorough, and I think investors, as this asset class matures, should read more about the tax implications.
Okay, that's great. And I'm going to ask this question of both firms here. I know a lot of financial advisors out there are getting questions about Bitcoin from their clients. What should they tell their clients, and where does Bitcoin fit in a portfolio? And does it have any diversification benefits that they should be speaking to their clients about? Like, how would you answer that question, Jan, if a client came to you and you were an advisor and they were desperate to get Bitcoin into their portfolio? What would you say?
Sure. I mean, look, I think digital assets are a type of disruptive technology, and the first thing that I think financial advisors have to do is not to poo-poo the technology, because frankly, every major technology and financial institution that I know of is investing heavily in blockchain technology. So whatever they do, don't just wave it off. They have to understand how distributed ledgers work. And it's sort of like making fun of the internet. It couldn't not develop, but you don't want to be making fun of it in the high probability that all these corporate CEOs are correct and using this technology. So that's the kind of number one answer I would say. As far as, look, if it's a tech investment, growth investors should have exposure to technology as a sector, right? It's a major sector. Then if this is a very early stage, then maybe you make it 0.5% or 1% of your overall portfolio. And I think that's easily justified, again, for long-term aggressive investors. I think people are afraid that you get sucked in by the mania and the momentum of these markets. But I think people, on the other hand, are so afraid of it that they don't get involved too. So I think the sizing issue is actually an easy issue to advise people on.
And just to add with respect to the diversification aspect, if you look at just our the DA10, the Digital Asset 10 Index, that is the top largest and most liquid, 10 largest and most liquid digital assets. They have done much better than Bitcoin. So the past year, they're up 4,300% versus Bitcoin, versus 1,500%. So as Jan mentioned earlier, the whole idea of the basket approach and diversification, the old lesson that we've learned on the ETF and seems to make sense for digital assets as well, from both managing sort of volatility as well as participating in the returns of some of the smaller tokens. And it's, the DA10 is actually fascinating and probably a longer conversation.
Absolutely. Well, we could go on longer. I'm going to give Raj the last word. What would you say to Canadian advisors who come to you and have clients clamoring for crypto assets?
Yeah, I definitely think that this has been more client-driven. I think that there's a lot of advisors that are interested, but I think a lot of clients are picking up the phone and calling their advisor and asking them what's the best way for them to buy Bitcoin or participate in the growth in cryptocurrency. I mean, I can't advise anybody in terms of, obviously I don't know what everyone's financial situation is and what their risk tolerance is. I totally agree with Jan in the sense that this really is an area of this digital world, and it should be a portion of technology positions for sure for some investors. I mean, I've seen some people saying that there should be a 1 to 3% allocation to Bitcoin or to cryptocurrencies within portfolios, and then for wealthier individuals, I've seen numbers like 5 to 10%. Again, I think you get the sense from this conversation today is that it's such a relatively new phenomenon that has really kind of grabbed a lot of people's attention, not just end investors, but the banks and advisors that work there as well. So I think everyone's trying to get their head around how to transact into Bitcoin and how it fits into a portfolio, what the correlation would look like compared to other asset classes in the portfolio, because in many ways it's very new. So or new from an investor interest perspective. So it'll be extremely interesting to see over the next little while how this all shapes up, especially the futures market. Again, I think this gives a great way for advisors to be able to actually participate, or for their clients to participate in the growth of cryptocurrency.
Absolutely. Well, guys, I really appreciate you taking the time. I thought this was a great session. I know it's a challenge to cover this entire topic in only 20 minutes, but I think we did a great job. So thank you guys for following up. Great information. Thanks, everyone, for dialing in to today's Inside ETFs webinar. We'll be back again next week. We're going to tackle the topic of commodities, traditional commodities, and whether they are a good product to add to the pile in 2018. So thanks, everyone, for joining. Thanks to my panelists, and talk to you all soon.
Thank you.
Thank you.